I'm Sarah Bunwell, the editor of InsuranceInvestor.com. I'm here with Corrado Pistarino, Chief Investment Officer at Foresters Friendly Society. Corrado is speaking at our ESG Investment Leaders Conference later this year, and ahead of that, we wanted to catch up with him a little bit just to find out what he's going to be talking about. Good morning, Corrado.
Good morning.
So my first question, and this is a big one, I think, is, what value can companies gain from ESG compliance?
Sure. I mean, let's start from this. We are very fortunate that we live in a society that has developed a strong awareness about the importance of natural resources, the need to provide the environment, to limit pollution, and also it has concern about the social impact of the economic activity. And we have seen that consumers, investors are putting increasing pressure on the private sector to balance the financial objectives in order to include broader outcomes, not just beyond profits, I'm saying, by saying that. There is also a concerted effort at the policy level, and this effort is led by the EU, to ensure that effectively all economic agents, from consumers to institutional investors, are incentivized to express preferences that align with this general theme of sustainability. So ESG has emerged over the past few years as a response of the business and investment community to these concerns over the sustainability of the economic model that we are running. We have seen progress. We have seen progress in the sense that there's been a trajectory that has moved from reactive policies. I'm talking about investing here. Reactive policies could be, for instance, the endorsement of exclusion lists, towards more proactive approaches like corporate engagement, impact investing. So in this sense, and I'm answering to your question, compliance with ESG by institutional investors has a strong signaling value because it means that we are there, we want to be there, and we want to do the right thing. However, there are problems that emerge when we explore more deeply what ESG compliance means. And for ESG compliance, I mean, it's a vague term. You can say that ESG compliance is compliance with the body of regulation on sustainable investment, responsible investment that the EU has developed, which is at this point in time the most advanced in the world. The questions that I have around this topic is, can a viable investment discipline be constructed around this principle? Is it the case that this principle have a strong enough framework, deliver a strong enough framework for evaluating the merit of these investments? Are the macroeconomic and microeconomic foundations solid when we look at ESG? As an investment discipline, is it endowed with intellectual rigor? I mean, are there principles which are codified in a way that doesn't leave a lot of space to approximation? And these are all open questions to me, and it would be nice when we meet also, at the conference to hear what the audience will say about these questions. One way, if I have another couple of minutes, one way of examining the discipline of ESG investing is to look at it as a risk management tool. So it's a process that identifies, assesses, quantifies potential impact of a new set of risk, for instance, climate risk. And these risks are important because they might have an adverse impact on the viability of the business, the performance of a portfolio. And here I'm effectively restricting my cone of vision within a very limited space, limited angle, which is the financial angle, the performance angle. So effectively what I'm saying is that there are risks are bad, risk can take us to losses, we need to do something about that. So we have seen a number of initiatives which to me fall into this, under this umbrella, the TCFD requirements for firms, the climate risk stress scenario by Bank of England on banks or insurance companies, the climate benchmarks developed by the legislation of climate benchmark developed by the European Commission. So the idea is that there are risks, businesses should be aware of this risk, corrective actions need to be taken. The problem that I have is that under this view, these are no different from any other sort of risk, any other sources of risk. Different investors will arrive at different conclusions with regard to the materiality of these risks, and sooner rather than later, market clears. So there will be an equilibrium which will be reached. When I look at the ESG compliant strategies, and here I'm talking about investment strategies, of course, for these strategies to outperform the general benchmark, market needs to be fundamentally mispriced with respect to the ESG risk factors. And that could be the case, but this is a very strong statement because big storages of latent value in the market are highly unusual. So, and on top of that, I actually suspect that market clears, currently at least, largely irrespective of ESG considerations. There is also a counter-argument. The counter-argument is that the fact that the market clears with little concern for ESG consideration means that there is actually a huge storage of value. It becomes an article of faith, either you believe it or not. And another comment that one can make is that, yeah, I mean, there are many different things. ESG can mean different things to many different people. And it's perfectly possible that there are strategies out there that could outperform the markets. The problem that I have with that is that it lacks specificity. It's not like saying that there is, I don't know, an established track record or some evidence that if I trade a currency basis between currency A and currency B, I will get some profit. That's very specific. When it comes to ESG, we are not yet at the level of specificity. Now, it's certainly useful to incorporate ESG consideration in any sort of investment analysis, credit analysis, equity analysis. No one denies that, you know, we are facing, in quote, very, very critical challenges. And of course, most of us believes in the materiality of some of the risks associated with things like the degradation of the environment, climate change. The point I simply wanted to make is that translating this observation into a viable investment strategy remains very challenging in my view. And I've got another couple of minutes. One last point, which is in a way more abstract. When we refer to ESG, we refer very often to something slightly different. We are not really only concerned about the replacement, market repricement, the fact that we can be landing with stranded assets, for instance. When we talk about ESG, we are talking something more profound, which is what the Paris Agreement and the European Commission, Bank of England also referred to, which is the response to climate change, making financial flows consistent with a pathwards towards a reduction in greenhouse gas emissions. And this is phenomenal, but we also need to recognize the constraints within which operate, and because we are investors at the end. And the underlying principle for us is whether portfolio allocation choices can have a non-transitory impact on the workings of the economy, on how the economy actually works on a day-to-day basis. And to me, this is a big question because it is a very much top-down approach to portfolio allocation rather than bottom-up, which is what normally people do. Such a view that we can effectively change the world with portfolio allocation choices, is predicated on an assumption which is uniformity of purpose and intent by the global investment community, effectively making ESG non-compliant firms or activities financially unviable. And this, in my view, is problematic in many respects. It ignores the existence of alternative investor habitats that do exist. It ignores the fact that non-compliance does not necessarily triggers a financial penalty. It may in the future, but not now. At least it's not fully priced. And it ignores the fact that it's eventually consumer preferences that will determine the state of the economy, to an extent also government policies. The state of the economy, the viability of a business. So I go back to my initial arguments, which is market clears. And I would hope, most of us do, that there would be a transition channel which it becomes more and more effective, that translates consumer preferences into consumer choices in goods and services, indirectly through portfolio allocation choices. And also, let's not forget, at least in democratic states, in developed democracies, consumers are also voters. So through that vote, they can also express a preference in terms of government policies. And eventually that will affect the viability of the business, of any business. I don't think we are there yet, and not with the tools that we have at the moment. I've actually had one final question, which is this one. There are a lot of talks about sustainability. I think, looking from a bit selfish point of view of an investor, but also asset managers and consultants fall in the same spectrum. Sustainability as a concept could be misconstrued, which means that there is an element of reputational and legal risk, which I don't think is fully appreciated and will become more evident in the future. So I would expect more conversations in the future around the messaging on sustainability.
Lovely. So lots to unpack there, and I completely...
Sorry, but yeah, I just wanted to give a big picture on where I stand, so everything else then becomes clear.
No, of course. And so I guess my next question is, zooming in, and you mentioned it briefly, specifically on impact investing, how should insurance investors in particular be thinking about impact investing? Should it be on their radar? Is it, what are your views on that specific element?
Well, in general, I think, we are at the very start of the process. We are even less advanced, than the general conversation on ESG. Now, impact investing is a well-established concept. It's not that was invented now overnight. It's been what international financial institutions have been doing for ages, since they were created after the Second World War. Some of them, at least, some later. That's also where the knowledge base lies. So they've developed a body of knowledge on what impact investing means, and I would hope that effectively the private sector will take that, will be welcoming that body of knowledge. So we have this progressive interest in the private sector investment community for impact investing. It means still very different things, different people, but in general, if I were to summarize what impact investing means, at least for me, is to be able to create positive externalities as one of the central objectives of an investment strategy. And that's very important. I think it's very important that insurance companies want to effectively generate a positive impact in our communities. In an ideal world, positive externalities should be compensated, should be rewarded also in financial terms. A lot are. If you think about, if you build a state-of-the-art environmental design, a building, that building most likely should command a premium valuation of other buildings. However, I would not assume that is always the case, because then it becomes a bit lame as well, that, I'm doing the right thing, and on top of that, I've got this stigma on impact, and at the same time, I make profit. So we can also be in a situation in which we recognize that we may be generating positive externalities, but those externalities are associated with an additional cost. And then it's up to the insurer to think if they are prepared to bear these costs. I go to the point that I mentioned before. I think it's quite important. If you look at the principle of impact investing, which has been developed, it's through three directions, effectively, three steps. One is impact, the other one is contribution, the other one is measurement. Impact needs to be a, how can I say, a willing step. And you need to generate externalities because you want to generate externalities. Effectively, you are almost taking precedence over financial considerations. And because a lot of externalities can be accidental. I'm investing in these assets, on top of that, tick, I have got a positive externality. And that's why I'm saying that, we are still not there. Am I comfortable going public and say that I'm investing, I don't know, in social housing, because above all other consideration, financial consideration, return consideration, my investment policy prescribes that I need to meet specific social targets. I'm not there yet. We are not yet there as Forrester, but I doubt that a lot of people will be there already. And then it comes to, the question around contribution, how much really I do contribute by this investment is really material what I'm doing. And the third big step is measurement. When it comes to measurements, of course, a very simple way of looking at that, which I've seen very much publicized, is using the United Nations Development Goals, Social Development Goals as a framework. More recently, the European Union has published the technical standards for sustainable disclosure. And that's also provided sort of categories. Then there are all set of questions which we already had for ESG. So how do we standardize that? Is it widely shared? Is it granular enough? How do we consider these methods in isolation as an aggregate? Are we looking at individual factors? Are we aggregate those factors with some kind of scoring system? What is the basis for that scoring system? You might also have, but that's the nature of the world. You might also have larger firms which can commit more resources. They can develop internal metrics and internal ways of measuring impact. Which is very much what happened with solvency. Big firms can develop their own systems. The smaller firm, like Forrester's, will be effectively following what happens in the wider market, and will be a sort of a data taker and a model taker. There will be also difference between public and private. Private is going to be easier. Public is, you have more information, but it would be much more difficult to determine the intent. You buy a bond issued by, I don't know, a luxury firm. What is the intent here? But even if you buy an infrastructure bond, it would be a bit more difficult to understand. Infrastructure bond may be a bit more easy. But if you buy a bond of a corporate that makes infrastructure, that it would be a bit more difficult to understand the level of intent and the level of contribution and measurement. So there are a lot of challenges, implementation challenges, and the way I think investors should look at it is with an open mind, with a lot of humility, and understand that we are at the very start of the journey.
Lovely, thanks, Corrado. I think I'm going to leave it there. I think we've covered some really interesting ground, and I can't wait to hear more of your views on all of this, and also to hear from all of our other speakers, how they're responding to some of these challenges at our conference later in the year.
Thank you very much.